Before we start this video, do like and subscribe to our channel and not miss on any updates.
Good morning everyone once again, and we are on day 2 of our fast track revision. Yesterday we covered Accounting Standard 2 with a good amount of questions, and today we'll be covering another very important standard from exam point of view, from your practical application, and also from a CA final point of view. In fact, whatever you learn, Accounting Standard 2 and Accounting Standard 10, the same thing you will learn when you learn Indias. Hardly any difference, right? So with this background, we'll be starting Accounting Standard 10. Now, as far as Accounting Standard 10 is concerned, a lot of students get confused when they have to deal with concepts like revaluation, present value of decommissioning cost, these two areas, and then sometimes component depreciation. These are the areas where students struggle a lot. That is the first thing. And second thing is, Institute sometimes asks theory question, means you have to give a judgment whether it has to be capitalized or not, what amount should be capitalized. So sometimes theory questions are also asked from this particular standard, where we have to be careful about the theory portion, what we write in the examination. So we also need to put some amount of emphasis and focus on that. Standard is very much logical. You will learn with logic. I will ask you to remember few things which you can remember, and then you will be ready for the examination. Now, as far as we know, AS10 deals with PPE, or what we traditionally used to call as fixed asset. Earlier we used to call fixed asset. Now, as far as companies' accounts are concerned, we use the term property, plant and equipment. So, when we say property, this property is basically your land and buildings. And this plant and equipment is basically your plant and machinery and any other equipment which will be a part of your business. Of course, there is one more angle called bearer plants, which is a part of Accounting Standard 10. Now, in yesterday's discussion, when we were discussing, yesterday we took an example stating that if there is a computer and if I am buying and selling these computers, then we will cover that under Accounting Standard 2. But if this computer is used for office purpose, then we will call it PPE as per Accounting Standard 10. One more example I would like to give you. Sometimes what happens is we have land. Now, don't jump to the conclusion that the moment you see a land, it has to be a fixed asset or property, plant and equipment. You again have to see what is the purpose. For this land, what is the purpose? If the purpose is to buy and sell, like for example, if you look at a construction company, then this will be your inventory. If this land is for, you use that land to construct a building for office purpose, then it will be covered under Accounting Standard 10. If this land is for investment purpose, so what is this investment purpose? Investment purpose basically means I bought a land. You would have heard a lot of these stories, right? Someone bought a land outside the city. Today it is worth crores of rupees. So if I'm looking at it from an investment purpose, then it will be an investment. We call it investment property, and that will be covered by Accounting Standard 30. So this concept, you have to make it very clear that what is the purpose? Am I buying and selling? Then it becomes my inventory. If I'm using it for my administrative purpose, for my business purpose, then AS10. If it is for investment, then Accounting Standard 13, right? If this fundamental concept is right, then the remaining part of the standard will become much more easier. So having said that, we'll come to exclusions later. Property, plant and equipment are tangible items. So this is the first thing. What are these? Tangible items. Now there are two things. One is intangible. The other one is tangible. As far as intangibles are concerned, this is covered by Accounting Standard 26, and tangible items are covered in Accounting Standard 10. Now, what is this tangible item? Simply put, something which has physical substance. Physical substance means you can see it, you can feel it, something like that. So, tangible items. Then, held for use in production or supply, or rental or administrative purpose. So, what are we using it for? Production or supply. For example, you have a factory, right? When you have a factory, that factory you use to produce goods. Those goods will be sold in the market. So, you are using for production or supply. all of your factories, your plants, equipments which you use for production of goods or supply of goods or supply of services. The office building, the studio from where I am recording, right? The camera that I'm using, the laptop that I'm using, the iPad that I'm using, all of these are used for supply of services in this case. So for that purpose, or rental or administrative purpose. Now this rental here basically means if you are using it for, let us say, car, you are a taxi company, you give cars on rent, something like Ola Uber is not the case, but let us say you are a cab company, you give these cabs on rent. These cabs are used for supply of services, so that also becomes your property, plant and equipment. Or administrative purposes. Now what are these administrative purposes? Generally corporate offices, your head office, you call it, you can call it the office, the sales office, the marketing office, which are not directly related to production but they indirectly are required. Okay, so two things, these are tangible items held for use in production or supply, rental and administrative purpose, and expected to be used for more than one period of 12 months or 1 year, right? Now, this is what is a property, plant and equipment. Property, plant and equipment is one of the most important item in the balance sheet, and this definition as such is not directly related or relevant for your exams, but they may ask you, sometimes they may ask you for MCQ. Okay, so that is one thing you can keep in mind, but other than that, there is nothing great to be understood here. This is important because this is a new concept. So what is this new concept? Bearer plant. What is a bearer plant? Now, this image you can keep in mind to understand what is a bearer plant. Now, what is a bearer plant? Bearer plant is a living plant. It is a living plant. Sir, how is living plant plant and equipment? So this you can consider it something which will produce goods for multiple period of time, and hence this is also covered under PPE, right? Now this plant, a living plant which bears agriculture produce, for a period of more than 12 months. So a living plant that is used in the production or supply of agricultural produce is expected to bear produce for more than a period of 12 months. That bearer plant is covered under accounting standard 10. So trees like orange trees, apple trees, mango trees, anything which will give you agricultural produce for a period more than 12 months will be covered under bearer plant. Now compare this with something like, let us say, rice farming or wheat. These agricultural crops, they do not give you produce for more than 12 months. They will give you only for one season. So these are not covered under accounting standard 10. And one more thing, you will not sell, there is a remote likelihood of being sold as an agricultural produce. Means this plant, not the fruits, these plants, you will not sell it at agricultural produce. If you sell a plant as an agricultural produce itself, then that is not a bearer plant. So what is an example? Say for example, timber. Okay, there are trees which are used to generate timber or wood. They are sold as wood only. The tree does not bear any fruit. The tree does not have any other utility. What you will do? You will grow those trees for 10 years, 15 years, and after that you will cut those trees and sell it as wood. So if you are selling a tree as such, as wood, then it is not a bearer plant. Not very important again from your exam point of view, but remember this definition, they may ask in MCQ. Okay, living plant, production or supply of agricultural produce. Just remember apple tree, mango tree, all of those trees produce for more than a period of 12 months and has a remote likelihood of being sold as an agricultural produce. Agricultural produce means you will not sell the trees, you will not sell the plants as such as agricultural produce. If you do that, for example, in the case of timber, if you cut the tree and sell the tree, that is not a bearer plant. I hope it is clear. Any question? If you have any question, please feel free to ask. Those of you who are watching on Zoom or those of you who are watching on YouTube as well. If you have any question, please feel free to ask. Okay, no questions, so we'll continue. So we have understood what is property, plant and equipment and what is the meaning of a bearer plant, right? Now, the next thing that we need to understand is how to calculate the carrying amount. Now, this is again, all of you would be knowing. We'll take the gross book value. Now, this can be cost or revalued amount. Revaluation will come to it subsequently. Gross book value minus depreciation minus impairment loss as per accounting standard 28 will give us the carrying amount. So, whenever we say carrying amount, carrying amount means after depreciation and after impairment. This is how we will calculate. And if we sell some property, plant and equipment, sale proceeds minus carrying amount will give us profit or loss. Sale proceeds minus carrying amount will give us profits or loss. Very important criteria, the recognition criteria. Recognition means when will I first time pass a journal entry or when will I first time bring a property, plant and equipment in my books. When will I do that? I will do that when it is probable that future economic benefits associated with the item will flow to the entity, meaning to say, with the property, plant and equipment, I will get future economic benefits. For example, if I have a plant and machinery, using that plant and machinery, I will produce goods. Using those goods, I will earn income. So, entity will get future economic benefits. So, by using that, you will get future economic benefits, then you can recognize. So, that is the first condition. Second condition is cost of the item can be measured reliably. This is very important. This happens in 99% of the cases. There is no confusion at all. What is the meaning of cost can be measured? If I purchase something, I have paid 1000 and I purchased an item of plant and machinery. Can I measure the cost? Of course, I can measure the cost. So, if I can measure the cost reliably and it is probable that future economic benefits will flow to the entity, then we will recognize property, plant and equipment, right? So, that is the first thing. Two conditions. One, future economic benefits, cost can be measured reliably. Learn this. Spend time, learn this because you may have to use this in writing some theoretical answers, right? Now, when we say we have to recognize, we need to pass a journal entry. For passing the journal entry, we need to know the amount. At what amount should we recognize? The property, plant and equipment? Now, as far as recognition is concerned, it depends on whether we have made the payment and purchased. So, let us say I paid 50,000 to purchase a laptop. That is one thing. Self-construction, I am building my own office or I am building my own plant. Or exchange of non-monetary assets. This is again important. What is this exchange of non-monetary asset? I have given another asset and I have acquired property, plant and equipment. Okay, so three categories are possible: purchase, self-construction and exchange of non-monetary items. Now, as far as purchase either by cash or on credit terms are concerned, it is very simple. Whatever we have done in AS2, similar conditions, plus we need to add some more things. Okay, so we will take the purchase price, whatever you pay to the supplier, that you will take. Then you will add any non-refundable taxes and duties. So if GST input is available, you will not treat that as a part of cost. If GST input is not available, if you have paid something, for example, custom duty, that you will not be able to set off, then you will add. Question will tell you whether credit is available or not. Then delivery and handling charges. Delivery and handling charges means the transportation cost, the loading and unloading charges. Site preparation cost. This happens especially when you are installing a machinery. So you have to prepare the site, you have to lay a foundation, that is included. Installation cost, any cost you pay to install. So think of it, if you purchase an AC, the purchase price, if taxes and duties, if you can take credit, you will not include. If you cannot take credit, you will include. Okay, for example, you pay GST on car. Tell me one thing, can we take credit on purchase of car for office use? Let me see how good have you revised GST. Can we take GST input on car purchased for office use? Right? We cannot take because that there are these are restricted items, and we cannot take if you are purchasing a vehicle of certain amount of seatings for office purpose. In that case, you will have, otherwise you will not have. Then any professional or consultancy fees you would have paid to the architect, you would have paid something to some legal advisor for the purpose of the property, plant and equipment, you will consider. Borrowing cost is permitted by accounting standard 16. So this, when we learn AS 16, we will understand if it is a qualifying asset. If it is a qualifying asset, then we need to consider. This time they had asked in an MCQ, there was a borrowing cost incurred on raw material which was used to construct a PPE. Such a long chain was asked, right? So conceptual understanding was very, very important, is very, very important actually in that case, right? So if borrowing cost, if it is a qualifying asset, as per accounting standard 16, we will consider. Then cost of testing. Sometimes we need to do trial runs before the property, plant and equipment can be actually operated. So if there are any testing cost, that also you will include. But if there are proceeds from sale of any product, then produced during testing, that you will reduce. For example, let us say we need to do a trial run. Okay, we need to do a trial run for operating a plant. With this, we got some output products. These products we sold in the market. So whatever value you realize, you will reduce from the trial cost. Then, very important, present value of decommissioning and restoration cost. This is where a lot of students get confused. Very, very important. Questions can be tested. MCQs can also be tested. Now, what is this? Let us understand. This generally happens in case of the property, plant and equipment which are used in areas like oil industry, coal industry, mining industry, generally in those cases, but the question can be from anywhere. So what you have to see is, what is this decommissioning? What is this decommissioning cost? Say for example, we purchase a plant and machinery. We purchase a plant and machinery on day 0. Okay, now the plant and machinery is for our, let us say, refinery purpose. We have to build a refinery, and that is what we are using it for. When we build that refinery, the refinery has a life of 10 years. So we build the refinery. When we use the refinery, there will be a lot of environmental damage, there will be a lot of land damage and all of that. The contract, what it says is, wherever you have taken the land from, or wherever you have agreed to install, or the government has said that when you complete your refining process or refining the activity is completed, after the end of 10 years, you have to restore the site. You have to take away all your machineries, you have to dismantle all your machineries, and you have to restore the site in a usable condition. Now this cost, restoration cost or decommissioning cost or dismantling cost, whatever we call it, this cost is incurred at the end of 10 years for something that we have done today for the purpose of PPE. The logic is, because we have purchased the PPE, that PPE has to be dismantled. So any associated cost that we are incurring at the end of 10 years is also for the purpose of this particular PPE. Okay, the cost is being incurred to run the PPE or to run the plant for 10 years. So what the standard says is, this cost, whatever is the cost, for example, 1 lakh is the cost. This 1 lakh of cost, you bring it to present value at year 0. How do we do that? So let us say rate is 10%. Rate is 10%. You can take your calculator, 1 divided by 1.1, you can do it 10 times. So 1 divided by 1.1, you can do it 10 times. Okay, I have the option, I'll just use the calculator. 1 divided by 1.1 to the power of 10. If we do, we get 0.3855. 0.3855. This is what 1 rupee spent at the end of 10 years is equal to 0.3855 today. Sir, how many decimals to take? You can take up to 4 decimals. If the question has given you the factor, use as per the question itself. So, if I spend 10 lakhs, 1 lakh I said, 1 lakh at the end of 10 years, here at the end of 10 years, what is today's value? 38550. So what the standard says is this 38550 in your present value terms should be added to cost of PPE. But sir, we have to spend 1 lakh at the end of the period. Yes. So what you will do? You will prepare a table. Opening balance, interest, closing balance. So you'll take year 1, 2, 3 like this. You'll do opening balance 38550. You will add interest of 3855 and you will calculate the closing balance. So closing balance would be 38550 plus 3855. You get 42405. So first thing what will happen is you will debit PPE to provision for decommissioning 38550. This provision for decommissioning is covered by your accounting standard 29. So any dismantling cost is there. That you will bring it to present value and you will add it to the cost of PPE. I hope it is clear. Then at the end of every year you will say interest cost debit 3855 to provision for decommissioning 3855. Next year what you will do? 42405. You will add interest of 4240. Then you will get whatever is the closing balance. Like this you will continue. So 38550 ultimately at the end of the 10th year will become 1 lakh. So that is what is called provision for decommissioning. Present value of decommissioning and restoration cost. This will be added to the cost of PPE. Added to the cost of PPE means you will debit PPE, you will credit provisions. Right? Then any other directly attributable cost to bring the asset to the location and condition necessary to operate for its purpose intended by the management. This you remember. Any cost, any directly attributable cost to bring the asset or to bring the property, to bring the plant to the location and location means where does the management want to install that particular equipment? That is the location. Condition. In which condition do we want? Do we want to install it? Do we want to not install it? Where do we want to install it? After doing all of that, so that it is ready for its purpose as intended by the management. How the management wants it? Any cost which is directly attributable to that will also be added to the cost of equipment. You will reduce government grant. This will understand in accounting standard 12. Trade discounts and rebates if at all it is granted. So this is the cost of PPE to be capitalized. A lot of time we have seen a 5 to 6 mark question just to test this particular concept has been asked. A 5 to 6 mark question just to test this particular concept has been asked. Again a quick recap. We'll take purchase price, we'll add purchase price, we will add any non-refundable duties and taxes, delivery and handling charges, site preparation, installation cost, professional fees, borrowing cost, cost of testing, after reducing the sale proceeds, present value of decommissioning and restoration cost, any directly attributable cost, any other cost which is directly attributable that will be included, will reduce government grant and trade discounts and rebates. Okay, so this you keep, and these 4 things also you should remember. Some things which will never form part of PPE. What are those things? First, cost of conducting business in a new location or with a new class of customer or cost of staff training. So what does this mean? I started a business in another location. Okay. In that location, I had to train staff. In that will that be a part of my PPE? No. In that place, I hosted a party, inauguration ceremony, ribbon cutting ceremony. Will that be considered a part of my cost? It will not be considered. Second, Cost incurred in introducing a new product or service. We do a lot of this, launch activities. You would have also seen launch activities, promotional activities. Those are also not incurred. Cost of opening a new facility. Any inaugural expenses not considered. Administrative and other general overhead cost. Any administrative or other general overhead cost which is not related to construction of PPE, which is not related to the acquiring of PPE, that will not be considered. Okay, this thing you should keep in mind and you should remember. Now what we'll do, we'll take up a couple of questions on whatever we have done so far. Okay, how to answer, and especially theory questions. See, these are 3 to 4 mark question easily for an examination, and it is very, very important. Okay, so far, do you have any doubt? Please let me know, yes or no. You can just put it out in the comment section or in the chat box if you are on Zoom. Okay. See this question. This question will help you understand how do we answer, these type of questions for examination purpose. Entity A, a supermarket chain, is renovating one of its major stores. So there is renovation being carried out. The store will have more available space for in-store promotion outlets after the renovation and will include a restaurant. So we are doing some renovation. The question is, should we capitalize the renovation expenses? Does it become a cost of PPE? Management is preparing the budget for the year after the store reopens, which include the cost of remodeling and expectation of 15% increase in sales resulting from the store renovation, which will attract new customers, whether it can be capitalized or not. Right now, whenever you answer the question on Accounting Standard 10 PPE, what you have to understand is, first, condition, probable future economic benefits. Will we get future economic benefits? And can we measure the cost reliably? The two conditions what we learned for capitalization. The two conditions was whether there will be future economic benefits and whether the cost can be measured reliably. Now, how do we measure future economic benefits? We will see, is there any incremental benefit because of that expenditure? Is there any incremental benefit because of that expenditure? If there is any incremental benefit, then we should capitalize. If there is any incremental benefit, then we should capitalize. So here it says, we will get 15% increase in sales. So first condition, and how we should write the answer? As per Accounting Standard 16, the cost of an item of PPE should be recognized if it is probable that future economic benefits associated with the item will flow to the enterprise and the cost of the item can be measured reliably. Of course, when you are carrying out renovation expenditure, can we measure the cost of renovation? Yes, we can measure. Will we get future economic benefits? Here it says there is a 15% increase in sales. Now, as per the case, there is a 15% increase in sales. And if there is a 15% increase in sales, definitely there is a future economic benefit. Hence, the cost of the item has to be capitalized. Okay. Now, you may have a doubt, sir, if there is a normal repair, should we capitalize that? See, normal repair and maintenance will only give you same level of performance. I'll give you one example. If you have a bike, if you own a bike, you give it for regular servicing. By giving it for regular servicing, it is only maintaining the bike. You are not getting any extra or additional benefit because of that. So that cannot be capitalized. That has to be expensed, right? Then, Entity A has an existing freehold factory property which it intends to knock down and redevelop. During the redevelopment period, company will move its production facility to another temporary site. Following incremental cost will be incurred. So, you have an existing factory property, you want to dismantle that and you want to remodel that, you want to redevelop that. Some costs are incurred. Setup cost 5 lakh to install the machinery, rent of 15 lakhs, removal cost of rupees 3 lakhs to transport the machinery from the old location to the temporary location. Can this cost be capitalized into the cost of new building? Right? Now, what are we doing? We want to redevelop a particular factory. Because we want to redevelop the particular factory, we are moving our existing premises, existing plant and machinery to a new location. Now, when you're moving into a new location, we are incurring some cost. Can we add it to the cost of the new building? The question we have to ask is, was the cost necessary to bring this new building? See, the relocation cost, the rental cost, it might be necessary for operation purpose. But is it necessary to get the building into place? See, I move to a different place. So, say for example, I own a flat or I own a home. I want to build a new home there. What did I do? I moved to a different place and I started paying rent there. Can the payment of rent there be considered as the cost of building? That is the question what the question is asking. So here what you have to understand is, if it is a cost directly attributable to bring the asset, which asset? Building, to the location and condition necessary for it to be capable of operating in the manner intended by the management. Now what are we incurring? Setup cost of 5 lakhs to install machinery in the new location. That is not for the building. So this cannot be capitalized. Rent of 15 lakhs. It is for my operations. So that also cannot be capitalized. Removal cost to transport machinery. So I am moving machinery from one place to another. How can I add that to the cost of the building? So all of these are operational cost and cannot be capitalized. Okay. So that is how you have to frame your answer. So what happened in the exam is, writing this theory will give you 2 marks. Analyzing 1 mark. Conclusion 1 mark. Okay, so that is how we have to answer. This is also very important. Here it says soft opening. See, this is not trial. Okay, so once it is ready for use, any cost attributable to bring the asset to the location and condition for it to be capable of operating in the manner should be capitalized. Running at less than operating capacity, there is sufficient evidence that the amusement park is capable of being operated in the manner intended by the management. What does that mean? The park is already ready. The park is ready for operation. We have done a soft launch. And just we are saying trial run its attraction. How will the customer come? And we are running it at a capacity of 80%. So official opening day is subsequent. This is not required to make the amusement park ready for use. So then how do we distinguish trial run which are required and trial run which are not required? See, trial run which are required are something which is mandated by the government or mandated by law or mandated for safety reasons. If you have opened the amusement park to the public, it is already ready for use. So trial run, if you would have seen, you have this metro trial runs. Wherever or train trial runs, railway trial runs you would have seen. Whenever they have to lay down a new line, they will do some trial runs. Only when the trial runs are completed successfully, then it is given clearance for opening. So here, this is not a trial run. Okay, so basic concepts we have covered so far. Any question, please drop a comment in the chat box, or if it is clear, drop a comment in the chat box. That will at least let me know that you have actually understood whatever I am trying to communicate. Okay. Clear? Okay. Thanks, Jasmine. Those of you are watching on YouTube also, if it is clear, just give a comment, sir. It is clear. Some motivation for me as well. Right. So we have seen how to measure when we have paid some amount for the asset. Now the next thing is self-constructed PPE. So what is this self-constructed PPE? I myself am constructing a plant, a building. In that case, how do we value? So all the costs that you have discussed above, all the cost which can be attributable to the construction activity and borrowing cost. Now here what you have to keep in mind is cost may be 100. Let us say salary. So when I'm building my own office, or when I'm constructing my own building, then I may use my own workers, and 100 may be the salary cost. Market price of the same may be 120. If I have to get it done from outsiders, I'll have to pay 120. So what should I capitalize? I should capitalize only 100. Any internal profit will be removed. Always take the cost of construction, not the selling price. Second, any abnormal amount of wasted material, labor or other resources, you should exclude. Okay, so that is one principle which you have to keep in mind when it comes to self-constructed PPE. Right? So self-constructed, you will not take internal profits. You will take all the cost which you have discussed here, and that will be given to you in the question. We'll see 2-3 questions of this range. This also can be tested in the examination. This is very important. Exchange of non-monetary assets. Exchange of non-monetary assets. A lot of students feel this is tricky, this is complicated. How do we do it? Now always think of it like, when I have to buy something, I pay money. If I have to buy, let us say, this pencil, I pay money and I buy the pencil. At what price will I value this pencil? Whatever amount I have paid. Plus, of course, taxes and all of that. Whatever amount I have paid, in that, with that value, I will, capitalize this particular pencil, right? So that is one thing. Now the question is, if it is any other asset given. So for example, let us say to acquire this pencil, I had to give another item. So what could be the another item? So here I have a keyboard. For example, this keyboard I gave to get this pencil. I gave this keyboard to get this pencil. Now, how should I value it? Normally, whatever you have given, you should take the fair value of that. Because think of this as money. I gave this, I got this pencil. I gave this, I got this pencil. So, if I've got this pencil, I will say, what value have I given to acquire the pencil? What value have I given to acquire the pencil? So, fair value of asset given up is always the first priority. First priority is fair value of asset given up. Now, I'll come to it. When PPE is acquired by exchange of non-monetary asset, if I gave one asset which is non-monetary, if it is monetary, it is no problem because I'll give money and I'll get the asset. Acquired by exchange of non-monetary asset, if I'm giving another asset and acquiring a new asset, in that case, if the transaction has commercial substance, then what should be done? If the transaction does not have commercial substance, I will use carrying amount. Now, what is the meaning of commercial substance? One more aspect. Commercial substance means by exchanging the asset, if my cash flows change, if my present value of cash flows change, if my risk of cash flows change, then it is a transaction having commercial substance. When I gave my keyboard and got this pencil, these are two different assets and my cash flow will change. But say for example, I gave my iPhone 16 Pro and got another iPhone 16 Pro of a different color, then the transaction does not have commercial substance. If the transaction does not have commercial substance, we will use carrying amount of asset given up to record the new asset. What does that mean? Say for example, iPhone 16 Pro, this is my iPhone. It is recorded at, let us say, it is recorded at, let us say, so it is recorded at 1 lakh. It is recorded at 1 lakh. When I get a new iPhone Pro, which is of same characteristics or it does not change my cash flows, anything like that, then in that case, this new iPhone will be recorded at 1 lakh. At what value? Carrying amount. Carrying amount means gross book value minus accumulated depreciation minus impairment. That is the first thing. If it does not have commercial substance, I will record the new asset at the carrying amount of asset which I have given up. That is the first thing. Second is, if it has commercial substance, then you have to look for fair value of asset acquired or given up. Sir, I don't know the fair value of asset given up. Neither do I know fair value of asset acquired. Then in that case, again, we will use the carrying amount. If fair value of asset given up or fair value of asset acquired cannot be measured reliably, then I will again use the carrying amount of asset given up. But if I can measure the fair value, then first priority is fair value of asset given up. If I have the fair value of asset given up, I will use that. But sir, the fair value of asset given up is not clearly evident. But fair value of asset acquired is more evident. Means fair value of asset acquired is more clear. So if fair value of asset acquired is more clear, then I will use fair value of asset acquired. First priority, fair value of asset given up. Sir, fair value of asset acquired is more evident, then use fair value of asset acquired. Or to avoid confusion, if you want to remember for the examination, take the fair value whichever is more evident. Fair value of asset whichever is more evident. Okay, so that is how you have to do the accounting. Commercial substance means the cash flows are changing, the risk is changing, the timing of cash flow is changing, the present value is changing. So let us look at question based on this. Entity A exchanges surplus land with a book value of 10 lakhs for a cash of 20 lakhs and plant and machinery valued at 25 lakhs. What will be the measurement of cost of the assets received? Now, land has a book value of 10 lakhs. They have not given us fair value of the land. They have not given us fair value of the land. What did we get? We got cash of 20 lakhs. So we gave land worth 10 lakhs. We got cash of 20 lakhs, plant and machinery 25 lakhs. So this is the fair value. Cash, it is a monetary asset. What will be the measurement of asset received? 20 lakhs cash received, you will show at 20 lakhs, and the plant and machinery fair value 25 lakhs. So what you will do? You will say plant and machinery 25 lakhs, cash 10 lakhs, to land how much? 10 lakhs. Right? And the difference to P&L 15 lakhs. That is the gain on sale. Here this will make it more clearer. Entity A exchanges car X with a book value of 13 lakhs and a fair value of 13 lakhs 25,000. Fair value of 13 lakhs 25,000 for cash rupees 15,000 and car Y which has a fair value of 13 lakhs 10,000. The transaction lacks commercial substance as the company's cash flows are not expected to change as a result of the exchange. It is in the same position as it was before. Now, whenever there is no commercial substance, what do we use? We use carrying amount of asset given up. What is the carrying amount of asset given up? 13 lakhs. So, the car that you have received, how do we value? We have given up 13 lakhs. For these 13 lakhs, we have received 15,000 in cash. So we gave 13 lakhs worth of asset. We got 15,000 in cash. Whatever is the balance left, 13 lakhs minus 15,000, 12 lakhs 85,000 is the value of car Y. So what we will do? We will debit car Y by 12 lakh 85,000. We will debit cash by 15,000. We will credit car X by 13 lakhs. So can we not do 13 lakhs plus 15,000? We cannot, because we have given assets worth 13 lakhs. We have got 15 lakhs in cash. So that part of course will reduce, and the balance represents value of the car. Okay. So this is about commercial substance, exchange of non-current assets, exchange of non-monetary assets. If you have any questions, you can ask me. I'll just take a minute to charge the pencil and we'll continue. Any questions in the meanwhile, not related to subject, otherwise also? You can ask questions in chat so that it is visible to others also, because audio may not be clearly visible to others. Venkat. Or if you are not able to type it out, you can ask. You can unmute and you can ask, because moving on. Before we move further to other aspects, quick discussion on the scope. Right. So before we continue the other aspects, the thing what we left earlier, scope. Now, when it comes to scope, what all are not covered? The standard does not deal with biological assets related to agricultural activity other than bearer plants. Meaning to say what? Agricultural activity has a lot of biological assets. Biological assets means your living animals, living plants, and all of those things which are related to agricultural activity. If it is related to agricultural activity, it is not covered here. But if it is a bearer plant, then it is covered here. That's the first thing. Then wasting assets. Wasting assets means something like mineral rights or exploration of mineral oils, etc. So you have mine. Wasting asset means as you extract the mineral, the asset value keeps on depleting, right? So that is not covered here. Then investment property, which is defined in AS 13, it is not covered here, but it has to be accounted for using the cost model. Meaning to say, for investment property, we will not use revaluation model. There are two models. We will not use revaluation model. That is one aspect, a small thing. Then, if there are spare parts, standby equipment and servicing equipment, if they meet the definition of PPE, these are covered by AS 10. If they don't meet, they will cover it under AS 2. Right, so these are important parts. Now moving on. This we have covered. When it comes to bearer plants, all the cost necessary to cultivate the bearer plants before they are in the location and condition necessary to be capable of operating in the manner intended by the management. Basically, all the cost incurred to sow the seeds, to nurture the plant, to grow the plant, so that till the time they are ready to give fruits, till that time you will capitalize the cost of bearer plants. See, as far as these bearer plants are concerned and agricultural activity are concerned, you will learn more about it in CA final. That is where it is more relevant. Then, when do we stop capitalizing the cost? So we said all the cost incurred till the PPE reaches the location condition necessary for it to be capable of operating in the manner intended by the management. So all those costs till the time it is ready as intended by the management, you will capitalize the cost. Once it is ready or once it is ready and once it is ready for operation, subsequent cost you will not capitalize unless it meets the definition of PPE. What do I mean by that? Say for example, we bought an AC. We installed it towards this wall of the room. Okay, you can't see the wall of course, but let's say we installed towards this side. It is ready for use. Right? That is what we had intended and we have capitalized. Subsequently, we felt that as per let's say Vastu, this is not right direction. Let us remove the AC and install on this wall. So, till the time I install this AC on this wall and I am making it ready for use, I have to capitalize. After that, if I have to uninstall and reinstall again, it does not significantly increase the future economic benefits. So such cost, the cost of relocating machine from one place to another, should not be capitalized but should be expensed. Okay, so that is one thing you have to keep in mind. Then, what about subsequent cost? You purchased a machinery. Subsequently, you will incur cost like repairs and maintenance, replacement cost, right? Any inspections and all of that. So if it is a day-to-day repairs and maintenance, this is recognized directly in P&L. Repairs and maintenance expenditure day-to-day is not capitalized. Then, if I have to replace the part of the PPE, then what should I do? Now you have to think of it in multiple dimensions. One, if by replacing the part, if the life of the asset increases, which means future economic benefit increases, I have to capitalize. Or in some cases like let's say airline, right? Machine has 20 years of life, chairs have only 5 years of life. I am replacing the chairs. So I will capitalize the cost of the chairs because existing chairs are no longer useful. Then, if major inspections and overall costs are incurred. Now, this major inspection and overall costs generally happen in big plants. Okay, not in day-to-day machineries and all. Big plants, you actually shut down the plant for 2-3 days and carry out a major overhaul that is needed so that the plant continues to run, or maybe sometimes it is required by law. Okay, or to increase the efficiency of the plant. So in that case, if there is an item of property, plant and equipment, you require major inspection for fault regardless of whether parts of the items are replaced. So for example, in an aircraft, the DCCA requires that, DGCA not DCCA, it requires that every let's say 2 years or 3 years, you have to carry out a major inspection. Each and every part has to be checked. Only then you can operate the aircraft. So this cost of major inspection and overhaul, this is capitalized. Now, how do we capitalize it and why do we capitalize it? This major inspection happens, let us say, once in 3 years or 4 years. Okay. So once I incur this cost of inspection, I can run the aircraft for 3 years. So I get the benefit of that inspection or major overhaul for a period of 3 years. That is why I capitalize. Okay. So if it is day-to-day repairs, I will not capitalize. If I am replacing parts, I will de-recognize the existing part and I will recognize the new part. And if it is a major inspection and overhaul, I will capitalize it for the life of the overhaul. Very important. Inspection costs are recognized irrespective of whether the cost of previous inspection was identified in the transaction when the item was acquired. So whether previously we had recognized inspection, overhaul and all, that is irrelevant. Whatever we are doing now, this has to be recognized. So what about the previous inspection cost incurred? That you have to de-recognize, but at an intermediate level, institute does not test such an advanced concept, but definitely in final level, you will be coming across these questions. Sometimes what happens is we purchase plant and machinery on a deferred credit period, means beyond normal credit terms. In that case, we will take the cash price equivalent to recognize the asset. For example, you purchased a plant, amount to be paid is 1,10,000. This is to be paid after 1 year. After 1 year. If you buy today, the cash price is only 1 lakh. So what the standard says is, though you are paying 1,10,000, the cash price is only 1 lakh. So you should recognize the plant at 1 lakh only. You should not recognize the plant at 1,10,000. So you'll always recognize it as cash price. So your entry will be plant and machinery debit 1 lakh to payable 1. But sir, we are paying 1,10,000. So in that case, what you will do? You will say interest 10,000, payable 1 lakh. It's 11 o'clock. To bank 1 lakh 10,000. Right. So this 10,000 of extra amount that you pay will be treated as your interest expenditure. 1 lakh 10,000 of what you pay will be treated as your interest expenditure. The difference between cash price equivalent and the total payment is recognized as interest over the period of credit unless you can capitalize in accordance with ACCA. So for now, here you just understand that this is my interest expenditure. If it can be capitalized as per accounting standard 16, then we will capitalize that, right? Okay. So deferred credit period part is also covered. So far we have covered simpler aspects of property, plant and equipment. Now, after depreciation is when we'll move to two important aspects. One is revaluation. Okay, that is very, very important. And changes in decommissioning liability, that is also very important. Depreciation, you have learned from since your foundation days. Depreciation is you will take either the cost or revalued amount minus residual value, that will be the depreciable amount. This you can use SLM or you can use WDV or you can use any other method which is systematic representation. When do we commence depreciation? When the asset is available for use. This term is very important. When it is available for use. Not necessarily you are actually using it. If it is available for use, you will start depreciation. Sir, I used it after 6 months. Does not matter. Does not matter. If you are using it, whenever the asset is available for use, you have to start depreciation. And you will stop depreciation when the asset is retired from active use and is held for disposal or the asset is derecognized. So once you have stopped using the asset, when the active usage has stopped, you will stop charging depreciation. Once you have classified it as held for sale, then also you will stop charging depreciation. Or when you derecognize that asset, then also you will stop charging depreciation. You will start when it is available for use, whether or not it is used. So sometimes what happens is the asset may not be actively constructed or actively used. Even in that period, you have to charge depreciation because depreciation is an expense for passage of time, for usage of asset, for technological obsolescence, for all of these things. So even if you have not used the asset, you still have to charge depreciation. Okay. So depreciation does not cease when the asset becomes idle. Does it become idle? Then we have something called as component accounting for depreciation. Now this you need to understand slightly more in detail. Let us say we purchased an aircraft, and for simplicity's sake, this aircraft are two parts. Of course, there are multiple parts. One is the engine, including the body, and the second one is chairs. Why am I giving this example? It is simpler to understand. Engine costed us 10 crores, chair costed us 1 crore. Sir, which chairs will cost 1 crore? Just understand. No, light chair, flying chairs, 1 crore. Engine has a life of 20 years. Chairs have a life of 5 years. We purchase this together by paying 11 crores. I don't know whether we'll get aircraft in 11 crores or not, but just for example, we say that we purchase it for 11 crores. Now, this engine, 10 crores, having life of 20 years, I should depreciate it over a period of 20 years. Chairs, I should depreciate over a period of 5 years. I should not combine both of these and say whichever is higher, I will depreciate over that period. So, I'll break it down into component. This is component 1, this is component 2. This is called component method or component depreciation. Component accounting and depreciation. So, for chairs, every year you will charge 20 lakhs. For engine, every year you will charge 5 crores, 50 lakhs. Every year you will charge 50 lakhs. Is this clear? Okay, clear? Yeah. Right. An asset may consist of different significant physical components. If an item of PPE has two or more significant components with substantially different useful life. So what I'm saying, two or more significant components with substantially different useful life or economic benefits, then each component should be recognized and depreciated separately over its useful life. Same way, land and buildings are separable assets and accounted for separately, even if they are acquired for together. Okay, so that is how we do the component accounting. We'll see a question on component accounting so that you have more clarity on how it is done. In the year 1617, an entity acquired a new freehold building with a useful life of 50 years. So, building has a life of 50 years for rupees 90 lakhs. Total is 90 lakhs. Breakup is given here. The entity desires to calculate the depreciation charge per annum using a straight line method. It has identified the following components with no residual value of lifts and fixtures at the end of the useful life as follows. So, they are given like this. Component land, it is infinite. It is infinite, 20 lakhs. Roof, 25 years, 10 lakhs. Lifts, 20 years, 5 lakhs. Fixtures, 10 years, 5 lakhs. Remainder of building, 50 years, 50 lakhs. Right? So that is how it is done. Now, once you have identified that okay, these are the components, we cannot say that this entire 90 lakhs will divide it by 50 and will charge depreciation, because the roof you have to replace after 25 years. So what we will do? This 10 lakhs divided by, so here you can see 10 lakhs divided by useful life of 25 years, we get 40,000 of depreciation. So residual value they have not given. If they have given residual value, you have to calculate for each one separately. If they have given residual value, you can have to calculate for each one separately. Then same way, lifts 5 lakhs, 20 years, 5 lakhs divided by 20, 25,000. 5 lakhs divided by 10, 50,000, and 50 lakhs divided by 50, 1 lakh. Land cannot be depreciated because land has indefinite useful life, or you can say infinite useful life, so it cannot be depreciated. So this is one where we can do the component accounting. This is important for MCQ. Which factors can determine, or what factors determine the depreciation method used? The cost, the life, and the residual value. Okay. Useful life of an asset. So useful life is basically the period over which we use the asset. Now this period can be in terms of time. So period over which the asset is expected to be available for use, or it can be the number of production or similar units expected to be obtained. So one is time. How many years will I use? How many years will I use? That's the first thing. Second is number of production or similar units expected to be obtained. Means it can be, for example, output. So there are some machines, first year we will get 10,000 output, then we will get 5,000 of output, then 7,000 of output. So that output, when we see, right, that output when we see, what is the output every year? So based on the output, we can charge depreciation. For example, if the output is, let us say, 1,000, 1,500 and 800. So what we'll do, we will total this. 1,000 plus 1,500 is 2,500 plus 800 is 3,300. The cost will be divided by 3,300, multiplied by 1,000 for the first year, 1,500 for the second year, and 800 for the third year. That is how we charge the depreciation. Useful life is dependent on usage of the asset, physical wear and tear, technical and commercial obsolescence, and any other limit. There could be legal limit or contractual limit, right? If, for example, a car, or let's say a truck in Delhi, it can be used for, let us say, only 10 years. So that is a limitation. Though a truck may have a useful life of 20 years, in Delhi if you are operating, you cannot operate it for more than 10 years. Then we have residual value. So while calculating depreciation, we said cost minus residual value. This is the value that is expected to be realized at the end of the useful life in today's terms. Because cost is also today's term, the residual value is also determined in today's terms, not what you will get after 15 years. Today's value of what you will get after 15 years. But for exam purpose, no need to break your head. The question will directly tell you that this is the residual value. And accordingly, you will have to do the question. Okay. If the residual value is greater than the carrying amount, then you cannot charge depreciation any further. So let's say one more thing, both this estimated useful life and the residual value, both of these have to be, these are estimates. So you will revise it. Every period you will revise it or you will re-estimate. Now when you re-estimate that, if the residual value subsequently is greater than or equal to the carrying amount, subsequently you will not charge depreciation. So this is one thing you have to keep in mind. You will not charge depreciation if the residual value is more than the carrying amount. You will not charge depreciation if the residual value is greater than the carrying amount. That is the first thing. Second thing is, if the fair value is greater than the carrying amount, means in the market the fair value is 100. My carrying amount is 80. Should I charge depreciation? Yes, I should charge. Just because the fair value is greater than the carrying amount does not mean I will not charge depreciation. I should charge depreciation. Okay. So if residual value is greater than the carrying amount, I will not charge depreciation. Whereas if the fair value is greater than the carrying amount, I should continue to charge depreciation. When should we stop depreciation? We should stop depreciation when the asset is retired from active use and is held for disposal, and the date the asset is derecognized. So it has to be either held for disposal or we have derecognized the asset, and that is the time when the asset, or that is the time when the depreciation has to stop, right? Various methods: straight line method, WDV method, units of production method. Straight line method means you will take cost minus residual value divided by life. WDV method means you will take a percentage, 15% or 20%. They will give you in the question. You will use this rate to calculate depreciation. Unit of production means, let us say 100, 120, 150, year 1, year 2, year 3. So total becomes 220 plus 150, 370. So let us say cost is 5 lakhs. You will do 5 lakhs divided by 370 multiplied by 100 for the first year, multiplied by 120 for the second year, multiplied by 150 for the third year. Then sometimes we may get some addition or extension to an existing asset. Means we have, let us say, added one more component of an equipment to a particular plant. Okay. Or we have added one more, let us say, unit. So let us say there are currently the capacity is 10, the plant has 10 units. We added one more unit or two more units. So this extra unit, how should we depreciate? This extra unit, how should we depreciate? First thing is, if it cannot be used independently, if the new unit that we have added cannot be used independently, then I should depreciate it over the useful life of, remaining useful life of existing asset. So let us say I have an existing machinery. I added one component to the machinery. That component can be capitalized, but that component cannot be used independently. If the component cannot be used independently, then what should I do? I should take that component and depreciate it over the remaining useful life. That's the first one. Second, if it is independent and can be used separately, then you will calculate, you will treat it as a separate asset. If it cannot be used independently, you will charge depreciation only to the extent of the remaining useful life of the existing asset. Impairment will learn as per accounting standard 28 subsequently. Now comes the most important part, one of the most important part in this standard, which is the revaluation model. Okay, before I touch upon the revaluation model, is there any doubt, any question so far? Please let me know, or if it is clear, just type in the comment that yes, it is clear, so that I can continue. Now, very important model of treatment, okay, and can be tested for 4 to 6 marks. In fact, in the final exams also these are tested, right? So this is very important. Two models the standard prescribes: cost model and revaluation model. When I say the cost model, basically I will recognize the PPE at cost, I will charge depreciation, I will charge if there is any impairment, and I'll continue to do this. I will never revise this amount. That is called the cost model. And if you remember, as per accounting standard 13, investment property should also be valued using cost model only. That is the first thing. Now, sir, what is this revaluation model? A lot of time what happens is, entity would have purchased machinery, entity would have purchased some assets, some, let's say something like a land and building they have purchased for office use, and the value of land has increased significantly. Now, it does not give a true picture if we continue to follow the cost model, because the value has increased, whereas we are showing it at the older value. Today's market value is pretty different. So what the standard says is, you can follow something as the revaluation model. Now, what is the meaning of revaluation model? Let us say the carrying amount is 1000, fair value in the market is 1200. The standard says you can replace this 1000 by 1200, you can recognize this 200 and do the subsequent accounting based on 200. That is called revaluation model. I am repeating, to take the asset from its carrying amount to the fair value. That is when we say we are following the revaluation model, right? Now, what is the increase or what is the gain here? It is 200. This 200 is called revaluation surplus. Sir, will it be only upward revaluation? No, there can also be downward revaluation. You can increase the value, you can decrease the value, but what you are doing, you are following something called as the fair value approach. So in the revaluation model, you will take fair value on the date of revaluation, and all subsequent accounting will be based on this revaluation only, or the revalued amount only. Okay. How frequently should we do the revaluation? Once in 3 years, once in 5 years. If the asset value is fluctuating significantly, you can do it every year as well. Now the key here is how to do the accounting. Okay, how to do the accounting. First we'll do this, how do we do the accounting based on the revaluation upward and downward. Then we will see how to actually pass the entries. If it is a first time revaluation, means we are revaluing the asset for the first time. If we are doing revaluing the asset for the first time, then if it is an upward revaluation, means from 1000 I have increased it to 1200. In that case, this 200 is called revaluation gain. Revaluation gain has to be credited to something called as revaluation surplus. Revaluation surplus. So what you will do, you will debit PPE and you will credit revaluation surplus. Never can you take this to P&L. You cannot take this to P&L. You will debit PPE and you will credit revaluation surplus. That is the first thing. So upward revaluation, first time, debit PPE, credit revaluation surplus. If it is downward revaluation, means I am reducing the value, then debit P&L, credit PPE. So downward revaluation will be taken to P&L. So if this 1000 became, let us say 700, then you would have said P&L debit 300 to PPE 300. PPE 300, right? Now, sometimes in the examination, we will get a question where they say cost is 1500, accumulated depreciation is 500, carrying amount is 1000. Carrying amount is 1000. Now, in that case, how do we pass the entry? One is this depreciation has to be eliminated. So, what you will do? First, you will debit. So, what we will do is we have to transfer this accumulated depreciation, eliminate it. So, what we will do? We will debit depreciation, accumulated depreciation by 500 and will credit PPE by 500. What this ensures is this now carrying amount of PPE has come down to 1000. From 1500 we will make it 1000 and then we will pass the subsequent entries. Now there is also one more approach called restatement approach. I would suggest not to do this unless specifically asked in the examination. Okay, if it is asked specifically, then you have to do this, otherwise don't do. You only follow the depreciation elimination approach. Restatement approach means cost is 1500, accumulated depreciation is 500, carrying amount is 1000. Now what is happening is 1000, for example, we are making it 1200. So if 1000 has become 1200, basically what is the increase? 20% increase. So 1000 becomes 1200, it is a 20% increase. So what you have to do? Here also you have to increase 20%. So 1500 plus 20% makes it 1800. 500 plus 20% makes it 600. This is called restatement approach. Okay. Now, so how did we get 20%? 200 is the increase and 1000 is the existing carrying amount. This is called restatement approach. So what you will do? You will debit PPE by 300. This 1800 minus 500. You will credit accumulated depreciation by 100. And you will credit revaluation surplus by 200. Revaluation surplus will remain the same, but you can do either depreciation elimination or restatement approach, but generally you should follow this only in the examination. Okay. So first time upward, again, first time revaluation upward, credit to revaluation surplus, downward, debit to P&L. Then subsequent revaluation. If first time is upward revaluation, again it is an upward revaluation, add to revaluation surplus. So upward, add to revaluation surplus. But if it is downward, then what you have to do is first use revaluation surplus, whatever balance is there. If revaluation surplus of the same asset, if it is not sufficient, balance will transfer to. I am repeating. If it is upward, subsequent upward, add to revaluation surplus. If it is downward, then you will use existing surplus first and then balance to P&L. For example, from 1200, just for example, we are bringing it down to 700. So what is the loss? 500. Now earlier when we did, we had, let us say, 200 of existing surplus. So what you will do? You will debit revaluation surplus 200. You have to credit PPE by how much? 500. The balance you will debit to P&L 300. Okay. So this is what you will do when already there is a revaluation surplus. First you will exhaust the revaluation surplus and then you will transfer anything to. If first time is a downward revaluation, if already it was a downward revaluation, then what do we do? Subsequent, if it is upward, first you will credit to P&L. So first time when we did a downward revaluation, here we would have debited P&L. Now when you are doing upward revaluation, you will credit to P&L. But you cannot credit more than what you had debited earlier. So earlier, let us say if you had debited 200 to P&L, now you can credit only 200 to P&L, not more than that. Okay. So what about the balance? Balance again becomes revaluation surplus. Earlier also downward, now also downward, debit to P&L. Revise this chart at least 2-3 times so that you are not confused for the examination. Okay. Any question on the revaluation model? Okay, no questions. Then, what do we do with the revaluation surplus? First option is you will transfer it to retained earnings when the asset is derecognized. So, whatever is accumulated in revaluation surplus, once the asset has been derecognized, once the asset has been sold, you will transfer that to retained earnings. That is the first option. What is the second option? The second option is what you can do is depreciation as per revalued amount minus depreciation as per original amount. Whatever is the difference, this every year you can transfer from revaluation surplus to retained earnings. First option, transfer when the asset is derecognized. Second option, revaluation surplus to retained earnings. Periodically every year, difference between the original depreciation and the revised depreciation, that amount you can transfer to retained earnings. Never ever will you transfer revaluation surplus to P&L. It can be transferred only to retained earnings. Okay. So for example, if earlier it was 1000 divided by 5, 200 is the depreciation. Now it is 1200 divided by 5, 240 is the depreciation. The difference of 40 you will transfer from revaluation surplus to retained earnings every year. Okay, so that is how you will treat the revaluation surplus. This, though I will be teaching you briefly, very slightly again advanced level concept, and don't expect it to be tested again in the examinations, right? First, if there is any changes in the existing decommissioning, restoration and similar liabilities. This is what the present value of decommissioning. There, if at all there is any change, if at all there is any change, how do we account for it? First, if you are measuring the asset using the cost model, if you are measuring the asset using the cost model, if there is an increase in liability, increase the value of asset. If there is a decrease in liability, decrease the value of the asset. For example, asset is at 100. I have to increase the liability by 20. So what will I do? I will make 100 plus 20, 120, and I'll increase the liability. If this liability I have to reduce, I will reduce the value of the asset. But if the reduction in liability is say 120 and I have asset only of 100, can I reduce 120 from 100? I cannot. So what will I do? From this 100, I can reduce 100, balance 20, I will recognize in P&L. So using cost model, you will either add it to the cost of the asset or reduce it from the cost of the asset. If there is any surplus left, you will transfer to P&L. Second, if the asset is measured using revaluation model, if the asset is measured using revaluation model, if there is an increase in liability, you will adjust against the revaluation surplus. Means you will not increase the cost of the asset. You will adjust it against the revaluation surplus. Any decrease in liability is recognized in revaluation surplus, or if revaluation was charged to P&L in earlier period, it is recognized as income. Simply put, if you are using revaluation model, change in liability, basically think of it as if it is a treatment or it is an adjustment of revaluation surplus. What is the meaning of that? If the liability has increased, so I have to credit something to liability 20. I have to debit something, right? I have to debit something, so I will debit revaluation surplus. Sir, why are we not debiting PPE? Because PPE is already valued at the fair value or using the revaluation model. So we will not again increase the value of PPE. What we will do? We will use the revaluation surplus to take care of the liability. Or think of it like this. Increase in liability is a loss. Increase in liability is a loss. So think of it as if there is a revaluation loss. Decrease in liability is a gain. So think of it as if there is a revaluation gain. So if you are using the revaluation model, again, if there is a decrease in liability, it is a gain. If it is an increase in liability, it is a loss. Think of it as a revaluation gain or loss and do the treatment. This is not very important from examination point of view, so don't break your head on this.
It's 11:30.
Right? After that, there is a small component called derecognition. Derecognition means when do we remove it from the books of account? Either when it is disposed or when no future economic benefits are expected from the asset. Difference between carrying amount and the sale proceeds will be treated as a profit or loss item, gain on sale or loss on sale, which we have already touched upon. Then there is this disclosure requirement. This you have to go through on your own. Just read it a couple of times. Don't try to by heart. Okay, just read it a couple of times. Don't try to by heart. Now in the next 30 minutes, we'll take up some important questions that you should be practicing from the examination point of view. Again, I'm saying this is one standard where 5 to 6 marks can be easily scored if a question comes up in the examination. Okay. Entity A, so this is on revision of life. Entity A purchased an asset on 1st of January for rupees 1 lakh and the asset had an estimated useful life of 10 years and a residual value of nil. On 1st of January of 17, the directors reviewed the estimated life and decided that the asset will probably be useful for a further 4 years. Calculate the amount of depreciation for each year if the company charges depreciation on SLM. Now, what does this mean? Purchased for 10 lakhs. So, make a note, cost 10 lakhs. 1 lakh. Life of 10 years. So, depreciation per year is how much? 10,000. When did they buy? January 13. Now, what did they decide? In January 17 means 13 gone, 14, 15, 13, 14, 15, 16. 17 has not yet started. Okay, so for 4 years, we have to charge depreciation. So, 4 years depreciation is 40,000. So, carrying amount at the beginning of year 5 or 17 is 60,000. 1 lakh minus 40,000. Now, what they have said, it will be only useful for 4 years. Earlier, we thought we'll use it for 6 more years, but now it is only for 4 years. So, this 60,000, you will depreciate it over 4 years, which comes to 15,000 per year. This is called changes in the estimated useful life. Sometimes this simple question can be tested. Usage began on 1st of March, ready on 1st of November. Depreciation should be charged when it is available for use. So you use it from 1st of November. This is a typical question which keeps on coming in the examination. They will add something, they will reduce something. Now the best part in this type of question is, there are, let us say 1, 2, 3, 4, 5, 6, 7 items here, right? Out of the 7 items, if you give treatment for 5 items also correctly, you will get 2.5 marks. I am repeating once again. Out of all of these items, let us say you have a doubt on consultants, just for example. Okay, after this revision, of course, you will not have a doubt, but let us say you have a doubt on this. Just because you have a doubt on this, don't forget, for the remaining correct treatment, you will get half mark each. You will get half mark each. So, you should not leave these type of questions in the examination. You should never leave these type of questions in the examination. First, cost of the plant as per supplier invoice plus taxes. So, taxes is included, 25 lakhs. Initial delivery and handling cost, 2 lakhs. Cost of site preparation, 6 lakhs. Interest charge paid to supplier for plant for deferred credit, 2 lakhs. Present value of dismantling cost, 3 lakhs. Operating losses before commercial production, 4 lakhs. Advice on the cost that can be capitalized with instant revised. Now here, should we capitalize cost of the plant? Yes, 25 lakhs. Sir, what do we do with these taxes? They have not told us whether it is refundable or non-refundable. If they tell it is refundable tax included, they have not said. But if they say that there is a refundable tax of 2 lakhs included, then from this 25 lakhs, it will say minus 2 lakhs. Okay. Delivery and handling cost, you will include. Site preparation, you will include. Consultants, you will include. Present value, you will include. Now, interest charges paid to supplier for deferred credit. This is your accounting standard 16. It is a part of your finance cost. Sir, can we capitalize this as per accounting standard 16? See, they have not told us whether the asset is qualifying or not. Unless they tell us that the asset is a qualifying asset or it will take substantial period of time to get ready, we should not use extra brain. We should simply charge it up to P&L. And operating losses for commercial production, any losses during the commercial production cannot be capitalized. It has to be charged to P&L only. So, the breakup of this will be 5 items, 2.5 marks, total 0.5 marks, and here analysis of this 1 mark. So, normally 4 marks. Sometimes they may give 5 marks also. Now, tell me, can we score 4 out of 4 or 5 out of 5 on this? Definitely yes. We should not leave this type of question. This you can again practice on your own. We'll also take up a few exam questions towards after this is done. This we have already completed. This one is also important. Srishti Limited contracted with a supplier to purchase machinery which is to be installed in its department A in 3 months' time. Special foundations were required for the machinery which were to be prepared within this supply lead time. The cost of the site preparation, again I'll need a minute just to get it charged. Any questions so far? How to approach exam question? Okay, so the question that we are discussing now is a typical examination question, and how do we approach that we'll actually see, and also we'll see a couple of exam questions. One thing is, this chapter, again I've been telling you multiple times, you can easily score 4 to 5 marks without any problem. So Srishti Limited contracted with a supplier to purchase a machinery which is to be installed in its department in 3 months time. Foundations were required for the machinery to be prepared within the supply lead time. Cost of the site preparation and laying foundations were rupees 1,41,870. These activities were supervised by a technician during the entire period, who is employed for this purpose at rupees 45,000. Technician services were given by Department B, which billed the services at 49,500. Now, cost is 45,000, billed at 49,500. We have discussed that internal profit should not be capitalized. So, we will take only 45,000. How many months? 3 months. Okay. So, here first important thing is this cost, then 45,000 into 3. This is not relevant. After adding 10% profit margin, we don't care. Machine was purchased at 1,58,34,000 inclusive of IGST 12%, for which input credit is available to Srishti Limited. So what they have said, 158,34,000 is the total cost. 1,58,34,000 inclusive of GST at 12%. Inclusive of GST at 12% means this represents 158,34,000 divided by 112 multiplied by 100 will give us the cost. So why are you doing that? Because this 12% we get credit. So when you calculate 1,58 lakhs into 100 divided by 112, we get 141,37,500. 55,770 transportation charges were incurred. Will we include? Yes, we will include. An architect was appointed at a fee of 30,000 to supervise the machinery installation. Will we include? Yes, we will include. So, site preparation included. Supervisor salary at 45,000 only. You will write a note for this stating that internal profit should not be recognized. Then, purchase price excluding taxes, so much. Transportation 55,750 and fees is so much. This is the amount to be capitalized. You will write a note why profit has not been considered. Okay. Sir, it feels easy to do material sums, but not with the exam. Similar type of questions are asked in the examination most of the time. So let us do one thing. Let us have a look at a couple of examination questions and also RTP questions. Then let us see how difficult it is. Okay. So let us say November 20, 5 marks question. Or if you have any specific attempt question which you feel was very difficult, you can just give me the reference. I'll immediately pull it off and I'll help you understand how to attack such kind of questions in the examination. Okay. Just a moment. Right? Okay. A Limited at following assets, calculate depreciation for the year ended 31st March for each. Machinery purchased for 10 lakhs. Residual value after useful life of 5 years is 10 lakhs. How much will be the depreciation? 10 lakhs minus 10 lakhs, no depreciation. So, no depreciation. Land for 50 lakhs, land has unlimited useful life, so no depreciation. Machinery constructed for 5 lakhs, useful life is 10 years. Constructed is completed on 1st of April. Company does not begin using until 31st March. So, when should we use? From the date it is available to use, that is on 1st of April, you should consider. Machinery purchased on 1st of April of 2017, 50,000 with useful life of 5 years and residual value is nil. 1st April, management decided to use this asset only for 2 years. So on 17, purchase for 50,000 for 5 years. On 1st April 19 means 17, 18, 18, 19. 2 years are completed. So 50,000 divided by 5, 10,000 into 2, 20,000 is the depreciation. So carrying amount will be 50,000 minus 20,000, 30,000. This 30,000 you'll depreciate for 2 years. So this is a very straightforward question. The same thing we discussed, the July 21 5-mark question, just now what we did. Okay, that is also a straightforward question. Sir, is it feasible to do September 24? Definitely we can do it. Okay, we'll look at few more questions. Here again, cost. ABC is installing a new plant at its production facility. It provides you with the following information. Cost of the plant 31,25,000. Estimated dismantling cost to be incurred after 5 years 2,50,000. Initial operating losses 375. This will not be considered. Delivery and handling considered. Cost of site preparation considered. Consultants considered. Only thing is 2,50,000. What do we do? Now sometimes you may get a question in the examination which is not complete. Not complete means they gave estimated cost, present value factor is not given. Now if present value factor is not given, then you will take as it is and you will solve it. Write a note in the examination saying that present value factor was not available and hence the present value has not been computed. Sometimes such things can happen in the examination. You should be very careful about that. This will be a quick revision. A Limited has incurred the following cost. Determine if the following cost can be added to the invoice purchase price and included in the initial recognition. Import duties paid. Can we add? Yes, because import duties are not refundable. Shipping cost and cost of road transfer for taking machinery. Yes. Insurance. Yes. Inauguration cost. No. Professional fees. Yes. Cost of advertisement. No. Administration. No. Cost of site preparation. Yes. So this can be again a 4-mark question in the examination. RS Limited has acquired a heavy plant at a cost of 2 crores. Estimated useful life is 10 years. At the end of second year, one of the major components, that is the boiler, has become obsolete, which was acquired at the price of 50 lakhs and requires replacement as further maintenance is uneconomical. Remainder of the plant is perfect and is expected to last 8 years. The cost of new boiler is 60 lakhs. Can the cost of new boiler be recognized as an asset, and if so, what would be the carrying value of the plant at the end of the second year? Now this is a very good question. Jasmine, Jan 25 RTP fully I'll be solving towards the end of December. You should do it on your own. Towards the end, second or third week of December, I will be solving Jan 25 RTP fully. RTP is generally meant for you to practice once. If I give the solution right away, you will not practice on your own. So please practice on your own. Definitely for every attempt I do the RTP. So Jan 25 RTP also you can expect in the second or third week of December. Okay, no need to worry about that. Right, now we purchased a plant at a cost of how much? 2 crores. Okay, estimated life is how much? 10 years. At the end of second year, means 2 years we have used the plant. 2 years we have used the plant. So on 2 crores, when we thought initially the useful life is 10 years, what is the depreciation per year? Depreciation per year is 2 lakhs divided by 10, 20. Sorry, 2 crores divided by 10, 20 lakhs. This 20 lakhs for 2 years becomes 40 lakhs. My carrying amount now is 1 crore 60 lakhs. Sir, I feel confidence with the concept but have no idea how to break down the question. So this type of questions is where you will find it difficult. What I am discussing right now. See how am I breaking it down. So first is what they have said. They have acquired at a cost of 2 crores. I have identified this. Useful life is 10 years. So the moment you see useful life of 10 years, back of the mind you should see depreciation. At the end of second year, the component has become obsolete. So what has happened? I purchased for 2 crores. At the end of 2 years, the component, a boiler, has become dysfunctional, or what they have said, obsolete. It cannot be used. So first thing what I have to do is I have to see what is the value at the end of 2 years, because everything has happened after the end of 2 years. So 2 crores minus 40 lakhs, I get 1 crore 60 lakhs. This is the carrying amount at the end of the 2 years. A boiler has become obsolete, which was acquired at a price of 50 lakhs. Now what has happened? Out of this 1 crore 60 lakhs, there is a boiler. there is a boiler, right? If there is a boiler, this boiler is there in 160. This 160 has to be split into two parts, the main machine part and the boiler part. Now, what price did we acquire the boiler? We acquired the boiler at 50 lakhs. So here I have 50 lakhs of boiler. Right? Now, if I have 50 lakhs of boiler, I have used it for 2 years. How much is 2 years depreciation? 2 years depreciation is 50 lakhs divided by 10 multiplied by 2, 10 lakhs. So 50 lakhs minus 10 lakhs, 40 lakhs is the cost of the boiler, or sorry, WDV of the boiler. If WDV of the boiler is 40 lakhs, then from this 160 I will remove this boiler, and now my balance amount is 1 crore 20 lakhs. On this 1 crore 20 lakhs, can I capitalize the cost of the new boiler? Yes, I can capitalize the cost of the new boiler, which is 60 lakhs. So 120 plus 60 lakhs, I get 1 crore 80 lakhs. Now this will be the value of the plant at the end of the second year. Okay, any question in this? The question which I did just now. So there is a requirement, September 24 paper. So let us have a look at it. I think we have it uploaded. So we can solve September 24 question on fixed asset. So I don't see any question in this part. MCQ we have already solved. Okay. Other questions on September 24 with respective chapters we'll consider. So if you can, so whoever was this user, I don't know your name, be bad as whatever is the name. There's no AS10 question I could see in the advanced accounting paper of September 24. Okay. If you have any other specific question, I would be more than happy to solve it. Most of the questions in AS10, whatever you get in the examination, they follow a specific pattern. Okay. And even if you don't get 100% right answer, as I told you in the question that we solved some time back, right? There are 6 items. Even if you can get 4 items, right, you will be able to 2 to 3 marks. Okay. How to approach the question paper towards the end of the session? Once we complete this fast track, we'll have a comprehensive approach on how to handle the question paper, which questions to select, how to handle AS 14 questions, how to handle consolidation questions, how to handle internal reconstruction questions. All of that will be done. It will be available in the in the YouTube channel itself. Okay, so no need to join the classes just for that. How to approach a question paper, what to do when there is a difficult question paper, all of that guidance will be given towards the end of December. Okay, for now focus should be complete the questions of the study material, past exam papers and RTP, and our objective is not 100% perfection. So this I have been telling to a lot of students. A lot of us want 100% perfection, and because of which we keep on doing more and more things and try to struggle. Okay, so in the examination, what you should do is, if at all there is a difficult question, because the question has come up, if there is a difficult question, you should do it towards the end. And I can bet, and I am telling this on live, I have told this 100 of times earlier to final students also, to inter students also, take up any question paper, 40 to 50% of the question paper will be manageable easily with an average preparation. Okay, let us look at this paper itself. Okay, record the journal entries for amortization in the books of Hughes Limited for the year ended 31st March. Acquired patents for 340, estimated product life is 4%, amortization was to be done in the base of cash flow. This is the same question which is there in AS 26. Then know-how by incurring so much, the know-how is used since 1418, useful life is 8 years. Company has not amortized the asset until 31st March of 24. So here also, this is asked for 31st March of 24. The entire amount, whatever has to be amortized, should be amortized. This is also a standard question. Then AS 15, this question, similar question, what you can see in the study material. Question on AS 22 on deferred tax asset. Then trial balance. Okay, so now this question, Delta Limited, can be slightly tricky for an inter student who is seeing this question for the first time. But again, if you read it carefully, revenue from this completion method for financial statements are 50, 34, 50 and 65. For income tax, it is 30, 52 and 67. Compute the deferred tax asset. Now, how do we compute? What is the income as per books? What is the income as per tax? Whatever is the difference, we'll create a deferred tax. Sir, whether it is an asset or a liability, if I have to pay more tax now, it is an asset. Okay, if we have to pay more later, it is a liability. So this also can be managed 5 marks. Financial statements, something where out of 14 marks, so this is a 14 mark question, 8 to 10 marks can be easily managed. Okay, then cash flow statement. This is again a standard question. You can see it in the study material itself. Now tell me, where is the question which is difficult? Now the question is, sir, first question I could not answer in the exam, but after the exam I could answer. Okay, so the problem is not the question is difficult. When you are writing the examination, your mindset or there is a lot of stress involved. Okay, because you are stressed, you are not able to answer. Now how to crack or how to handle this situation is, don't pick up the first question. Don't pick up the question which you see immediately. Pick up a question which you can answer easily. So if I have to tell you, for example, just for understanding, let me just do that. Cash flow. This is a question which you have seen earlier as well. Because you have seen it earlier, start with a question which you can answer. Start with a question which you can answer with 100% confidence, which will ensure that the remaining questions can also be managed. Okay, so it is more about stress management than understanding, and also do a lot of writing practice. Especially I have seen in case of accounting students, what happens is, because it is accountancy, they'll just read the answers and they think they can go and write in the paper, examination hall. That doesn't work. You have to put pen to paper and you have to practice. Only that will give you exam practice. Okay. So I'm not seeing your name, but whoever is putting this comment on YouTube, what you can do is you can put your question in the forums if you want any more guidance. Accordingly, I'll be able to respond back to you. Okay. So today we complete AS 10. Okay. I hope you have enjoyed the session. If yes, do give a thumbs up to the video, and we will again meet tomorrow. From tomorrow onwards, it will be on Zoom. It will not be live on YouTube. Okay, so from tomorrow onwards, we'll continue on Zoom. Whoever have enrolled for this fast track classes, and we'll follow the same approach: full theory coverage plus questions discussion plus your examination question and any more question which you want me to solve. So should we start with MCQ or descriptive? It depends. If you are comfortable with MCQ, start with MCQ. And I would suggest you to start with MCQ because in MCQ, 20 out of 30 marks can be easily scored. Okay. If you feel that MCQ you could not do well, how to approach MCQ? I already did one video on the same day itself. Okay. After the exams, what were the answers? If you look at the way I have approached the MCQ questions, and of course some MCQs were tricky. Don't aim for 30 out of 30. Aim for 20 out of 30. That should be our target. Okay. So thanks a lot for joining in and have a good day.